Hey, 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 thanks for being in the REC experience. I'm your host, Takhar, with your girl, Laura, Dutchie, Elto, Stewart. What's happening?
You're loving my orange attire here today.
Look, as I was
Representing
driving,
my heritage.
as you should be, because as I was driving in today, I was thinking, I was like, it's June 16th or 17th. And wow, if we weren't in pandemic mode, we would be in the first full week of the Euro Cup football. It's one of my favorite tournaments, even more than the World Cup of soccer, believe it or not, because you only get the class of competition, in my opinion, anyways. And Clem, I know you're liking the fact that we're talking about this because how much you like football, and the Portuguese team are the defending champs. We would be watching it, and I know you, Laura, you would be supporting your team with the.
I sure would be. I'd be wearing my actual jersey, and I know both you, Clem, and a lot of people out there. You might have your teams, but everyone, a little bit of them loves the Dutch.
I can't disagree with you. Like long before I met you, by far some of my favorite teams were always the Dutch in these tournaments. But they just couldn't get over the hump. They could not get over the hump.
Just can't seem to put it together. I don't know what it is. My grandmother, 97 years old, she couldn't care less about soccer, but she tells me about her sister. And she always says she'd have to take tranquilizers. I don't know if this was like a Prozac pill back in the day, but whenever the World Cup would be on, she'd be watching her team, she would just freak out. She'd be so excited and anxious about watching the game that she would need to calm herself down. And I see a lot of her and myself, actually. It's tough to watch. Sometimes I like when things like the Olympics and big sporting events are on, I can't watch. I get so worked up. I want us to win. I want my team to win so badly that it's a stressful time. And so, the Raptors not being in the playoffs this year, like there being no basketball to watch, no sports to watch, I've been at ease. I'm at peace now.
Well, it's funny that you mentioned the Raptors right behind me here. You see our boy Blazeworks came in, did a little painting on our back wall. You see the championship trophy there. On the side over here, you get to see a little mural of
that was a year ago this week.
This year, 1 year ago. Yeah. Shout out to the city of Toronto.
We're still number one.
We're still number one. We're defending champs next year. It'll be funny how it'll be funny how it all kind of plays out, the NBA playoffs and so on and so forth. Everyone's figuring out what to do and how to get in touch with people. If you're in business, how to navigate through what is really one of the biggest economic downturns. I hate to use this word, right? How unprecedented this time is.
Don't use it. Don't use the word. It's so cliche at this point. I mean, 3 months, all I've heard is that this is unprecedented.
We got through it. Like, I have to say, we got through it so far. Knock on wood.
Knock on wood, yeah.
Families have been safe and very sensitive to people who lost friends and families and co-workers and colleagues. Really feel for everyone, but it's starting to seem anywhere, especially here in Ontario, people are getting out, right? Like even shops at Don Mills, you see the parking lot full during regular business hours. Yeah. I'm starting to see so many more cars on the 401. I know, Laura, you can walk to work. And so I can walk to work,
but I drive, and my drive takes me about 20 seconds longer than it normally does. So definitely there's people going back. I mean, I think the downtown core is going to have a hard time just from like a perspective of how are we going to get all these people up the elevators safely. And so I don't foresee businesses down there necessarily opening up soon, like in terms of like the high-rise towers. But yeah, I mean, around here, like, I kind of feel like it's almost back to normal with the exception of I just can't go to a restaurant. And from the looks of it, that's gonna be changing in the next couple of weeks, hopefully. And I look forward to having a nice draft pint.
So one thing we haven't been able to get, we've been able to get a lot of food, curbside pickup and so on and so forth, and the skip dishes and Uber Eats. But I agree with you. It's that cold pint that we have not been able to get. And I'm excited. Mayor Tory here in Toronto has said that patios are going to be opening up very, very soon. I see the shops at Don Mills. The patio furniture is coming
It's all
back.
ready. They are ready. And I got to say, I am ready to support them. I mean, they took a big hit, and I'm ready to get back out there and start spending some money and get these businesses back up and running for sure.
And if you are a small business right across the country of Canada, and you are in the process of opening up in your province, in your city, please reach out to me right now personally on Instagram. It's at JazzTakhar13, number 13 on Instagram. I want you to reach out and shoot me a DM, because every night on Instagram, Monday to Friday at 9 p.m., I do Nightcap with Jazz. A lot of you guys and gals know that platform that I'm using.
You got a nice little Nightcappers following there.
Yeah, I do. I got some nightcappers. I appreciate that, Laura. I know how many times you come in and just support. But if you are a small business owner, please hit me up on Instagram. Again, it's at JazzTakhar13, because I want to bring you on for you to tell your story, what you had to go through during this pandemic, and how you're pivoting now. It's all to support your business. My nightcappers will do what they do best, which is support in whatever which way they can. So please reach out. Yes, I got some nightcappers, but Laura, you got some app prayers? What is that again?
I guess you'd call it app prayers. Yeah, I got a nice little thing. So every Friday after I leave the office, which, you know, the time does vary, but just like, you know, like when people were working, after you leave the office on Friday, a lot of people go out to their local watering hole for a drink with colleagues and friends. And I kind of started doing that by myself with my people, you know, on social media. So on Instagram, around 7 p.m. on Fridays, I get a nice big glass of wine for myself. I sit in my closet, because I have a walk-in closet. I'm not just sitting in a dark closet.
Why did you pick your closet? I don't get it.
I don't know. That's my happy place. I mean, it's the most organized place for sure. It's all color coordinated, and I have a very colorful wardrobe, as you can see. And so I just like the colors, all of it. And it's my creative space, because I love putting outfits together. And so it just seemed like my happy place. And obviously at the end of the day, as I come home, and normally I'd get dressed out of my office clothes. So I always find myself in there anyways. And then I thought, well, why don't I just shoot it in here? And then that way, you know, I'm not bothering the rest of my family, getting them to turn the TV off or do whatever to distract them.
I thought you were just trying to hide from Rudy, and that was your only kind of
yeah, Rudy's technically not allowed in the closet. I have to put up a gate every day. But if he were to, I think he came in one time and he was a good boy. He licked the camera and then he left.
And so that happens every Friday. You do that. Go check Laura's app pray out at is it Laura Stewart TO, the Instagram profile?
It is, yeah.
Awesome. Make sure you guys go check that. Clem, put both profiles out there in the bottom of the description. Very excited to have had our boy, our broker, but he's become a friend, a big brother to myself. I know I can say the same for Seamless and yourself as well, Laura. Mr. Chris Slightham, broker owner here at Royal LePage Signature, between himself and his brother and father, who have done so much in this community in and around Don Mills. They have a little over 1,200 realtors, but they allow REC. So REC is under the umbrella of Royal LePage Signature. They allow us to try new ventures, test out new things, bring as much value as we possibly can to you, the listeners. And so thank you to the whole Slightham family. But he came on to our Brunch with REC. We've been having these webinars, free webinars, every single Saturday morning at 10:30 a.m. since the pandemic, since the lockdown.
Yeah, pretty much since it started, right?
Yeah, we've had thousands upon thousands of live viewers come on. And so we would love to have you on as well. Just go to visit brunchwithrec.com, brunchwithrec.com for this upcoming webinar every Saturday. You can sign up. There's no cost. It's, share it with your friends and family. And we're just educating people about real estate.
Yeah, we don't always make these ones a podcast, but Chris, I mean, he's such a great speaker, and it's so nice knowing that we're working with someone who continues to educate himself and push himself and get all the information that we need as agents to go and do our job. And now essentially this time we kind of just cut out the middleman and said, you need to listen to this guy, because he's a wealth of knowledge, and he's definitely got his finger on the pulse when it comes to what's happening in the market. He's a broker to over, what is it, 1,100?
1,200
agents. So, and he comes around and he talks to us all the time. He really wants to know how individual deals are going. He knows the number of offers people are getting, what problems people are having. And so he's just so great to have as part of our family.
50 years of real estate experience the Slightham family has, and we have him on speed dial. And so I'm very, very proud to call him not only a broker owner, a mentor, but really a friend. Call him on so many other occasions just to get his advice, because he's been around the block, right? You won't be able to tell by looking at him. He looks like he's 27, 28 years old still, but he has a lot of experience when it comes to real estate. And kudos to the rest of his family as well for everything that they do. So make sure that you leave us a comment. Let us know what you thought of this episode and past episodes. If you're watching on YouTube, it's easy. Leave a comment below. If you're listening on any of the podcast platforms, do us a favor, leave us a rating, because it helps the algorithm, and it helps allows us essentially to get to more ears. So that would be greatly, greatly appreciated. Make sure you have yourself a fantastic day. Laura, thank you for everything you do, girl.
You bet, Jazzy, and to everyone else, enjoy the show.
REC Experience presents Real Estate, Entrepreneurship, Leadership with your host, Jazz Takhar. The REC Experience podcast is now on air.
We have Chris Slightham, owner of Royal LePage Signature, which consists of over 1,200 realtors. We'll talk a little bit about, just the managing and how you've kind of had to navigate the business. Like, if you can just talk really quickly, Chris, about kind of your family background, because I know you've been doing real estate, and I was joking a little off where I'm not sure if you're on. I mean, you look like you're 27, 28, but you've been in real estate yourself for over 35 years, practicing and so on and so forth. But your family has been in this real estate world a lot longer than that.
Yeah. We've been very blessed by this industry and by real estate itself. My great-grandfather started as a bricklayer when he came to Canada originally. Then they got into building their own homes, and so they went through the Second World War. My grandfather in building homes in Leaside, if you're familiar with Toronto at all, they would tell you, if they were here today, they would tell you stories about during the war they had houses partially finished, and obviously people went off to war. There were no buyers. They had to board them up, and back then they were selling brand new homes for $6,000 or $7,000. Those houses are still there today. The semis and the detached homes that are well over $1 million in that marketplace. And then we started the brokerage business as a family 55 years ago, and it's been a great journey being a part of the real estate, the city. I mean, it's amazing to think about how much growth we've seen in that time period. We've seen a lot of ups and downs, and I've got a chart to share with you today to talk about the macro, what's happened in the last 40 years, which we've navigated through, and I'll share some thoughts with you. But we've been in a position to be able to be a part of and witness real time the challenges, the wins, the value of real estate, and what it's
real time over decades, mind you. Real time over decades, which is right. A unique perspective and a valuable perspective.
Yeah. No, it's great, and I think that's I hope what we do every day is help share that information, and as we always talk about, and you guys do a brilliant job of this, is educate, and that is really the critical piece, is whatever we can do to help people understand what's gone on over the years, so that we can learn from the past and try and understand how the future will behave for us in the markets. I think is incredibly valuable, and what I enjoy doing is sharing that. So I really appreciate the opportunity to be here today.
Now, Chris, with the 1,200 realtors that you manage, what are you seeing from their point of view? Like, how are they showing homes? How are they navigating the actual, like, what CMOS is kind of dubbed within the REC nation and the REC world as regular real estate, like helping people buy their first condo, move up, like smart size, move up and move down. How are buyers, home buyers, and home sellers being affected, and how are realtors in our office kind of getting purchasers into homes and condos?
That's a great question. And going into this back, I mean, it's even hard to remember now. It's gone by so quick in 12 weeks or so. I mean, you can think about back at the end of March when things were really coming to a height pressure there with, what was going on in Italy in particular, and thinking about what was possibly coming to our communities here, and it was a scary time. So, we quickly, I think the government made some good decisions. They decided to try and contain things. And quickly, everybody tried to navigate and learn, okay, how can we do this? Because real estate didn't stop. Real estate is, as everybody I think now knows, is deemed an essential service. And there's a good reason for that. I mean, there were people that had, before, call it March 13th, had bought homes, and people that had sold homes and needed to buy or needed to sell either side of the transaction. That world doesn't stop. They didn't put they put a pause on the economy on purpose to allow us to navigate through this incredibly frightening, frankly, time of a health crisis. But they didn't pause real estate, because real estate is difficult to pause. This is something that, they say the three needs in life: food, clothing, and shelter, and we're talking about one of them, right? And that's what continued on. So we figured out, okay, quickly, let's listen to the protocols. We're wearing masks, we're sanitizing all surfaces, we're providing hand sanitizers. We went quickly to very high quality virtual tours by a company called Matterport, which really allows you to navigate things through. You can see them, and even in the new construction world, they started bringing out virtual tours as well for properties. And so it was out of necessity. Everybody quickly pivoted. We very quickly moved all our operations staff to home offices, set them up, so we didn't actually miss one day of work. We just remotely moved everybody home. They did a fabulous job supporting all of our clients and our realtors' needs all the way through. But it was, it is possible to show properties. It has been all the way through. From a resale standpoint, there is a moratorium on open houses at this point in time, which makes a lot of sense.
Yeah.
Obviously.
But if you are following the protocol, we've had a great experience all the way through. We've been, on a relative basis, we've been very, very active as an organization, and we're in, the busiest city in our country, and one of the greatest. I'm a little biased about this, but I think one of the greatest places.
I do want to make a quick comment.
I think the three people here are definitely biased, but with reason. I was also happy, and I know, Simos, I cut you off earlier, okay. But I was very, very happy to hear. I think it was yesterday the announcement came that you're allowed, like the circle now is increased to 10 people. But more importantly, you're allowed to hug those 10 people. And so that was nice to hear, that we didn't just have to do the elbow bumps or the fist bumps, or not even touch each other. At least we're allowed to hug, because everyone knows here Simos is a big teddy bear and he's a big hugger. And so I wanted to make sure I get to hug him too.
Remember the COVID shuffle when you're doing the feet taps? I just wanted to make a quick comment on what Chris was saying. That we never skipped a day, and it's not like we were comfortable, because the whole world had no clue what this was. So I want to go a little like flashback Thursday style to that March 15th to April 1st time, when like legit I remember Jazz saying, like, we're leaving the office. We're looking at each other, we're like, are we really leaving? Because nobody told us to leave. But it was still that time where you had to kind of like find your ground, like where's the bottom, like what's happening right now. And I was like F word, I guess, is what I said. I was like, yeah, I guess let's get Shem, who's our administrator. She processes 600 deals a year. And I said, yeah, let's get her computer moved. And we're looking at each other, well, who wants to touch it? So like literally we didn't know what to do. And you said we never skipped a day. We never had a choice to skip a day.
Yeah.
There were people in the middle of deals, like they bought a home or they sold a home, and they're looking at us for direction. What are we doing here? Is my house going to close? Is the bank working? Is a lawyer going to put a stamp on title? What's happening? And we're like, I think it's going to be okay, but
We'll
just
get back to you.
we'll get right back to you. So
We'll get right back to you.
it was truly a frightening time for many, like no joke. And we had to really tap our feet and find the bottom and make sense out of it, and kind of keep our cool through it and lead these people through battle. So I can't say that when they first came out and said real estate is an essential service, and people are like, oh, is it really an essential service? Unless it's you in that hot seat, be quiet. Because you didn't just sell $1 million home and are sitting now on the fringes not knowing what's going to happen to you and the anxiety that can cause. So yeah, kudos to your organization, Chris. Kudos for pivoting so quickly and making those changes. I know what it took for me and Jazz, and there's 50 of us in our organization, but there's 1,200 in yours. So I know what it takes for our organization to move because it's big, but I can only imagine the logistical nightmare that it was for those couple weeks to get everything kind of flowing and get it going. So great job, great leadership.
So let's kind of go into the macro of kind of what's happened in the last 40, 45 years in real estate. Maybe Simos, you can bring up, share up a screen, or I'm not sure if Chris has it, or Simos, you're controlling that right now.
We actually have our producer in the back. Bobby and Ty are both in the background.
Perfect, boys.
Guys, if you can please get that up.
It's actually by far one of my favorite things to look at. Chris, you brought this to our attention not too long ago. Just talking about kind of the macro economics and the macro real estate market for a big sample size. You know, sometimes in stocks you can day trade stocks, but you cannot day trade real estate. Maybe you can just talk a little bit about this slide, Chris.
Absolutely. And I think this is really one of the most important pictures to understand of real estate over time. And I think what we did is we looked back 40 years from 1980 to 2019. That's the data we have so far, full year data for each of those years. And what we have here is, you can see the red line is the average sale price tracked throughout that 40-year time horizon. And then the blue line is the number of sales that happened each year. And the reason why we shared this and put this together is we wanted to help everybody understand how the market behaves, most specifically in times of change. And you can see that the blue line, the sales, the sales activity, the sales volume bounces around more erratically, frankly, than the price line does. And there's been so much conversation in the last 8 weeks here about values and where they're going. This, I hope, will help people understand how they behaved over the years, specifically through times of change. So one thing I'd like to point out is the first big drop that you see in around 1990. I don't know how well people can see the screens. If you're watching it on a handheld device, you can maybe kind of zoom in and you can see the drop there in 1990. The blue line comes way down below the red line for the first time, and in this particular timeline since 1980. And you'll see what happened there. If you're familiar with real estate at all, you know that we had a significant correction in 1989-90 in our marketplace, and you'll see how transaction volume activity plummeted very quickly. Prices didn't move that quickly. So, when you're talking about, values and concerns over what prices are going to do in the near term, real estate values actually don't move that quickly. And the reason why, frankly, is people don't trade real estate like they trade stocks. So, just this week, you saw how volatile the stock market is. If you're invested in the stock market, in the last 90 days, your heart rate has probably looked worse than the blue line on this chart, right? So it's
well, no, for sure it does. Not maybe, right? For sure.
Thursday and Friday, we're a big indication of that. where real estate values, because it's not a super liquid asset class, which I think is a good thing, because you can't just impulsively trade it. It takes a little bit of time. I think that's a healthy effect of real estate. So the price doesn't move as fast. If you fast forward to 2008, 2009, you can see there's a bit of a jump in the market on the blue line in particular. You'll see that is the global financial crisis that was the last massive economic crisis that happened in our lifetime, that rocked the world. And if you think about what we went through globally at that moment in time from 2008, September of 2008 would be likely close to the peak of that before you saw it start to decline there sharply when Lehman Brothers went under in the middle of September, and everybody stopped. I can remember the time very clearly. Transaction volume at that moment in time dropped 50% overnight. Exactly. Thank you, Bobby, for circling that. Perfect. or Simos or whoever did it. That's
I think it was Bobby.
It was myself.
That's why we have him here.
and so it's absolutely brilliant. So that moment in time is critical to watch. And then, but you'll see the red line it sort of flattened out a little bit just below that. You can see that spot if you want to just circle that a little bit, just right below that point. It's basically flat. So if the exact numbers were on this chart, you'll know that in 2008, things just flat. The prices actually didn't drop. You're right, exactly. Right in that point, prices didn't drop. They actually just continue on. But look at the volatility of the sales volume, the unit volume, where people kind of froze up and said, oh my goodness, should I be buying real estate? Oh, I'm going to sit on the sidelines. Should I be selling real estate? Maybe because the buyers are sitting on the sidelines, all sit on the sidelines, so that transaction volume. Then you fast forward to 2017 in our marketplace, and you can see the run-up of prices and transaction volume as we were running into a mini bubble period in there in 2017. And you'll see there that we had a run-up in prices and a run-up in unit volume. And then boom, April 2017, the 16-point fair housing plan came into place and put on the brakes.
Yeah.
They were looking for what we were coining a soft landing, and ultimately they created that. But what happened in a very short period of time at that moment, as you can see, the blue line went way down, because exactly as transaction volume happened, as that change happened, as the 16-point for housing plan, that was the 15% foreign buyer tax came in, and all of a sudden, boom, everybody said, whoa, wait a second, let's press the pause button on activity. You can see how little the prices came down. We did have a price adjustment, which was necessary as far as I was concerned at that moment in time. Things were getting heated. We were seeing double-digit price increases, which are unsustainable over the long term. Just as a note here, which you've probably shared with folks before, the average percentage price increase over the last 40 years has been about 6.7% on average. So as everybody knows, the further you get away from an average, either above it, way above it, then likely you might need to correct. But if you can stay as close to the average as possible, there's less potential for price change. And that's not what was going on in the early 2017. We took a bit of a pause there, but knowing that it's the GTA, knowing the growth that we have, knowing the immigration policy that our country has in place, it was a necessary pause. And look what happened. We came back very quickly, and as confidence grew, away we went, and we saw things take off. So here we are.
Chris, I just want to interject, just because you're talking about those 3, 4, or 6 months leading up to 2017, that April of the apex in April of 2017. Did not the last 6 months, October 2019 to March 15th, 2020, did you not smell the exact same scent in the air? That anomaly in growth, the anomaly in listings to sales ratio, that exact same double-digit creep month over month. I bought a house last month and it's up $50K. That's not normal.
That's not normal. So frankly, we were talking about this fact exactly happening again, returning. We were running into a situation where, we have had a supply and demand challenge in the GTA for 5 or 6 years now. So as immigration was ramping up, they couldn't get the housing infrastructure supply to catch up with the population growth. And that's really, what was putting tremendous pressure and will continue to put pressure as we get things rolling again back into the marketplace. And this is really what what happened. And that's what was happening this prior to March 15th. We would have seen that red line sales prices continue dramatically. And you would have seen the blue line continue. If we were to add on to 2020, you'd see that blue line pop right back up on transaction volume, as well as we were trying to accommodate the demand. The market was trying to accommodate the demand. And I've said this before, and I stick by it. If it wasn't a COVID challenge in real estate, we would have possibly, I think not possibly, we would have had a different kind of challenge in this spring market at this exact moment in time. We would have been thinking, oh my goodness, prices are up 20+% year over year. We're in that bubble territory again, that unsustainable price growth area again. And something else would have had to give one way or the other in the GTA market. I can't speak for other markets across the country, but in ours, that's exactly where we were heading.
Okay, so just to go off what you're saying, and so there's two components that I want to highlight. I'm going to ask you a question about what we just discussed. The question for you to start thinking is, people have a misconception that a realtor, that the real estate industry is happy when prices jump and they go up.
Yeah.
There couldn't be a bigger misconception as to what we think of an imbalanced market. So I want you to speak of that. But I also want to get into, once you answer that question, I really want, I no longer want Chris Slightham, broker of record of the GTA's biggest real estate brokerage. I want you to change hats. You are an avid and generational real estate investor. I want to talk about your family's outlook on real estate investing, because you're not the first one to invest. Your great-grandfather was laying bricks. So let's talk, like, once you answer the question about the misconception of what the industry feels about rising prices, I want you to guide our audience, who are the most aspiring investors, and they act, Chris. Last week, 25 people went into contracts because they want to grow, they want to build their legacies. And I don't think there's many people that could possibly give a better guiding light. And I'm not trying to put you on the spot or anything, but your family has been very blessed and very smart and very strategic in how you've built your real estate portfolio. And I will benefit from it, I know as a fact, but I believe everybody on this webcast is going to take some serious gold nuggets out of it. So please start anywhere. So
part one to that is the misconception about the excitement over values going up. I mean, we all want our real estate to appreciate, and we're all on the same page with that. But real estate is, I think any asset class, slow and steady wins the race. It's a long-term game that you want to take. And when things get heated, whether it's real estate, whether it's gold, whether it's oil, we all know how those stories end. Whether it's a stock that took off too fast, we know, generally speaking, how those stories end, and they don't end well. I always like to say the backside of that curve is not very exciting when it's going to the moon like that. And that's why, when you're seeing these 20% year over year price pressure in any marketplace, it's a dangerous place to be relative to what because we have the luxury of decades of data now. And so you look at the 40-year story of the Toronto Real Estate Board stats, and you can see it's a 6.7% annual. So you get too far off the line. So as a homeowner, if you're about to leave the real estate market, maybe either permanently or otherwise, or move locations where it makes financial sense, if you have a big pop in value, sure, it's very exciting. But even as an investor, you know, I've always said this, I'm actually not really that focused in our family, you know, switching to that for a second to tie it all together. You know, we've not really been focused on the actual value of the asset. We're always have been more concerned about cash flow over time, because that's your recurring revenue that everybody dreams of having while you're sleeping at night. Your investments are paying you every day. So eventually you can retire on that recurring revenue. That's been our simple formula from day one. Buy and hold, pay down the debt, and then the cash flow comes and you enjoy a fabulous, you know, retirement. Yes, is it nice to have the equity there? Is it nice to know the equity value's gone up over time? It's that's sort of the headline, the glamorous, you know, side of the story, that, you know, those semis in Leaside were $6,000 brand new, you know, 60 years ago, and today they're, you know, $1.5 million. You know, it sounds exciting to say that, but really, you know, yes, you can sell something and get the cash for it, but you're going to pay tax on that. And then what are you going to do? I guess you could spend it, of course, and have fun, but is that really going to sustain a great story on a long-term basis? And that's really the essence of how we viewed real estate. So stability in prices, because it's healthier for people. When you have a market that has volatility, it gives you anxiety and uncertainty. We love certainty, and that's the one thing about real estate. You take the long view, and that's, you know, our message right through thick and thin, through that 40-year chart, through those highs and lows. We have never sold real estate along the way.
I love it. I love it. Wow.
That's a very consistent message, eh, Jazz? When was the last time you sold real estate, bro?
Well, exactly. I mean, my parents sold a property in late 1990s, and I learned from there. I was like, oh man, I wish I kept that property.
Never again.
I was like, never again. It's not going to be, I wish I had. It's always going to be telling my future. I'm always thinking about my future self, saying, I'm glad I did. I'm glad I did. I'm glad I did. Now, your portfolio does not consist of, and the Slightham portfolio does not consist of 3-4 doors. And so everybody who's watching and listening right across the world, this is an extensive portfolio, and we're speaking to Chris about the portfolio. Chris, why do you guys stay within the Greater Toronto Area always?
Because it's you know, little bit of convenience, but also we know the market, and we know that there's factors in this particular market that you know, they give you a sense of certainty over time. So you've got, you know, Toronto is you know, the economic, you know, no offense to any other part of Canada at all. I mean, I'd love to live in many parts of this country, but if you're looking from a pure business standpoint, it's not an emotional discussion, it's a business discussion. So it's about economic viability. It's about a diverse economy. It's about growth, jobs, you know, immigration, infrastructure, banking. You know, it still has a significant manufacturing component to it, and maybe that'll even grow again. Technology, business investment, it goes on and on and on. So when you're in a market like that, where you know you've got a couple of key factors, you've got population growth, which is, I think, one of the fastest growing cities in North America. It's rated one of the top cities in North America to live from a lifestyle standpoint. Yes, it's very expensive, but there are jobs in place. You can, you know, there's great employment opportunities. And with that, you have, you know, a consistent story of price growth over time. And that's great. I mean, that's simply, you know, a great long-term story. And you have tenants, you know, you have, you know, our favorite asset class is residential rental properties. I mean, that's really basically 100% of what we invest in. And because it's simple, it's not glamorous by any stretch, but you know, people need a home, and the rents are consistent. They're paying the rents. And even in this today, as we were going through the last, you know, 90 days of uncertainty, as much as there was concern about paying rent, yes, a few people have struggled, but the government stepped in and provided relief programs, and rents are being paid, and away we go.
You said slow and steady. I always think about the tortoise and the hare, and I like to remind people who won that race, right? It's that slow, steady, every single year. I don't want to see the 13, 18% increases. We spoke about this. It's that 6%, 7% year over year compounding. And Albert Einstein said that was the best invention of all time, because it is compounding year after year. Guys, girls, we promise you we're going to get into the Q&A. I did want to make sure that we brought up the slide and spoke about the micro market of the Greater Toronto Area for the last month and our most current stats. And so, Chris, if you can also help us just kind of navigate through the market indicators that we like to look at with the infograph. Bobby and Tyler, if you can bring up the current stats so we can give everyone a much clearer picture of what's going on.
Let me just dig into it really quick here. So the stats that we watch closely are supply and demand, even more than price. So I'll talk about price first just to get it off the table, because I know everybody likes to hear that. So the average sale price was actually up 3% year over year in May, even in all this.
Were you surprised by that, Chris?
Absolutely.
Because I was. Yeah. Okay. Good. Continue.
Yeah. Absolutely. So that shows the resilience. There you go. That shows you that's Oakville. Actually, do you guys have the Greater Toronto Area? So, and what's also interesting, and what's really happened here, Jazz, over the last the last 60 days, is not only did buyer volume drop, but also inventory dropped, and those are the two crucial numbers that we actually want to look at. And as investors, you really want to focus in on that's the supply and demand situation that's going on. So you've got, supply is the number of listings available, and demand is the number of sales. And that's really what's absolutely crucial in the marketplace. So what we have to do is we watch very closely. So that ratio, we have about 2.5 months, as you can see there, of standing inventory. Months of inventory is a big number, 2.49 as we have on the chart. And that really shows you very clearly that we're still have 2.5 months of inventory is technically still a seller's market. Now, in that, there's micro markets, which you have to watch very closely, because the GTA is a big place. And so within the GTA, there are pockets where there's 7 months of standing inventory based on the number of transactions. So to calculate that number, just to be clear, you take the number of available properties for sale versus the number of, and divide it by the number of transactions, and then you'll get to see what that is. So if you look at, perfect, right there. You look at the number 11,448 active listings versus 4,606 total sales, and that gives you that 2.5 months of standing inventory. If you go back to 2019, you look, there were 20,000 last May. There were 20,000 listings and almost 10,000 sales. So you have closer to 2 months of inventory. If you go back, actually, you can't see it on this chart. Oh, if you go back to 17, you'll see there's 18,000 listings, 10,000 sales. That was 1.8 months of inventory. So that was that bubble moment of low inventory. Actually, it's not on this chart, but I have my notes with me here. 2016, May of 2016, there was 1 month of standing inventory.
Wow.
Think about that. In a marketplace of a population of closing in on 7 million people, you had 1 month of inventory. There was 12,900 listings available. There were 12,700 sales. Like, it was unbelievable.
Insane.
So no wonder the prices took off at that period of time. And those are the numbers as investors you want to, as investors, just as homeowners, as if you're trying to understand directionally where pricing is going, you have to look very close at those numbers. And here we are in May, in the middle of a global pandemic. We only have 2.5 months of inventory. It's creeped up very slightly this year, likely to but at a point where we're still seeing a 3% average annual year-over-year price increase. Because the demand, even relative to the time of the market we're in, is still there. And we talked about it earlier. over the last 5 years, we have had a supply shortage, and this is why we're in the situation we're in the GTA, because of the growth of population. And these numbers are showing exactly what's going on.
Chris, I'd like to point out something on this slide that's so huge. Number of sales is 27,313. Year to date, we're down 22%. So I would really like for everybody to really take that in. In a market that has been put on halt, the world has been stopped for precisely half the year thus far. So we're into June. So we've had 3 months of, let's call it normal, when things were going crazy, but everybody saw something coming, and then the world came to a halt. So this number, by all accounts, should be down 50 or more %, but it's not.
No.
And this is where people need to understand what insulates Toronto is not because we're a better city than anyone else. We have a housing crisis that has been ongoing for the last 2 decades. We have not built enough homes. We have had too much bureaucracy, constraining development between the green and the Manhattanization of Toronto, between getting developers to have to dance for 10 years before they can get the green light. The only reason this market is always insulated from the 2008 financial crisis, the COVID right now, and everything else is because there is a real housing crisis, not a health crisis like COVID. So when COVID is lifted, we're going to be back to our old tricks, meaning we cannot find and service our clients with a demand that they want.
We had a house. I was sorry, Simos, I was saying that, even before the pandemic, for the last couple of years, we've been saying we've had a housing epidemic for a very, very long time, because we cannot figure out, and I think this is more city related, and I personally never go on political rants, but at the end of the day, I feel for them too. Like, how do you figure it out? Like, we want to preserve our land with the Greenbelt legislation, and now you're starting to see, pre-COVID, we were seeing applications in the city of downtown Toronto to build on top of buildings, and even build on top of Yorkdale Mall, right? Because just to figure out how do we get more supply into the system, because I think, I've always quoted about 200,000 people coming into the Greater Toronto area year after year, but you and I were having a conversation a couple of days ago, Chris, just to set up the schedule for today, and you gave me some staggering numbers from an immigration perspective. Why don't you touch on that, and then we'll jump right into Q&A, because otherwise, Chris, between the three of us, we can go on till 7, 8 p.m. tonight, and I do not want your kids not to get more time with you today, because I know how that is.
I could talk all day. I do love the topic, because I love it because that it has done so much for people, who have taken the steps to invest and just to own homes over the last 40, 50, 60 years. I mean, it's a great news story, but this is the issue, and it is going to be choppy. I mean, let's get it out on the table here. It's going to be choppy for the next 6 to 12 to 18 months as we're navigating through this time with COVID-19 and getting a vaccine in place and a better understanding of how the virus behaves, and it's going to be choppy. But it's the government's stated goal right this year is 340,000, welcoming 340,000 people to our country, and they have also talked about raising that goal to 500,000 people a year, because Canada has so much land. I mean, we're blessed with this amazing country that we have, but we have a lot of land, and so in order to have economic growth and long-term sustainability, frankly, we have capacity nationally. Now
we need density. We need it.
We need it, absolutely. So that they're focused on making that happen. And now we've got a pause button, going right. We've hit the pause button on global travel, for a purpose, to save lives. Once this has been resolved, which it will be, over time, that will come back. And as soon as that comes back, it's going to come back with a surge. People that have been wanting to move here, that have been in the queue, it's going to happen, and that will take off, and then we'll have more pressure on, as to your point, onto prices and to rents, until we can get that supply to meet that demand level. And I hope we do, as I said, because we've got to resolve these spikes of pricing that gets caused by too much demand and not enough supply. I mean, the good news story is here, just I want to touch on one more thing before we jump to any questions people might have, is, since 2015 to May 2015 to May 2020, prices are up 33%, or roughly about 6.6% a year. The reason why that's important to note is that's right in line with the 40-year average. So how you enter any time, whether it's a global pandemic, a crisis, God forbid, whether it's a financial crisis, dictates how the market behaves leaving that. And knowing that we're not entering this at the top of a chart that has that, hockey stick, as they call it, like design on it, that you're at a peak moment in time where prices have accelerated rapidly. They're sitting right in a very healthy price range that has, as I said, it's about 6.6% over the last 5 years on average. That's a good news story, which allows you to navigate through that with less downward pressure on prices when there's a challenging time you're going through. And that's something that I think we have to all try to understand. I hope I did a decent job at that.
Fantastic.
Explain that concept, but that's something.
Well, why don't we ask our audience quickly before we go into Q&A? Has Chris brought you the value you were looking for in understanding the GTA market, or is there some burning subject? If you want to just go into the chat and just give us a quick thumbs up and let us know what you thought of that piece. I think it's so important personally. So
yeah, I like that. Please be. If there's anything I've missed, or if there's anything in particular you'd like to know, I hope that I can add value and give you that perspective.
Not surprisingly, we're getting an overwhelming great job and thumbs up. Like on all the other platforms, I usually say give us the hearts because I like the colorful hearts and all that kind of stuff, but that's not on Zoom right now. So
remember the ones I gave you the other day when I came to your Instagram?
Yes,
I went on for like a 30-45 second marathon of going like this, and your whole screen was lit up with hearts.
As Bobby Puim comes on, and we're going to jump into Q&A, I wanted to, again, thank you, Chris, for just going through the numbers in so much detail, again, in terms of the stats for the Greater Toronto Area, as well as kind of the macro, your macro kind of thesis on investing from the Slightham family's perspective, which has been entrenched in real estate for such a long time. For anybody who's watching or listening right now, if you would like the stats for not only the Greater Toronto Area, but the micro markets that Chris spoke about, because there's probably 1,000 micro markets. We don't have the stats for all the 1,000, but for the major cities within the Greater Toronto Area, the Oakvilles, the Burlingtons, the Pickerings, Ajax, the Mississaugas, the Richmond Hills, and the Vaughns, please shoot an email to info. That's info@reccanada.com. info@reccanada.com, and just put in the subject line market stats Mississauga, market stats Richmond Hill, and our team is standing by, and they'll make sure that they get you over the stats for your micro market, because we all know that if you're thinking about selling a home in Brampton and purchasing a condo in downtown Toronto or vice versa, the stats are totally different. Brampton does not behave like downtown Toronto does from a statistical perspective, and we got you covered. Just send that over. There's obviously no cost for anybody who's watching. And if you're on YouTube, just shoot that email at info@REC Canada. Bobby, if you don't mind joining us, my friend, let's put our boy Chris Slightham here a little bit on the hot seat. We'll pick 3-4 questions, and we'll go from there. Look at it. We've got Chris Slightham everywhere. We got him on the left side.
I got him everywhere. I love this. It's my favorite thing.
That's rather embarrassing.
It's a little weird.
I just wanted a side-by-side comparison of how good looking the two of us are. Yeah.
I do normally wear a suit.
Jazzy,
Yes.
can I ask Chris the first question? I have a question for him.
Yes, go.
All right. This is a personal question, Chris.
Uh-oh.
How does it feel for you to drive down the street with your sons in the car and explain to them what a housing provider really is? So it's one thing to talk about investment dollars and cents, but there's a very big side to investing that kind of sits inside your left chest. What does it feel like to be a housing provider? What does it feel like to know that your legacy will be left being a housing provider, and your sons are going to take that spot one day? How does that feel, bro?
Yeah, it's a great question, and I think it's one of the three necessities in life, and so it's always nice. It gives you a sense of pride and comfort that we've been able to participate in something that is so critical to everybody's daily life, whether it's on the brokerage side and helping people with their very first, maybe leasing and they're stepping out of their home and their family home, and they're moving into their first property or their first purchase is an amazing monumental time to their first investment. It's been that alone is an amazing experience. And then to be, blessed with the opportunity to be able to invest in real estate and do that for a long time and provide that very, very necessary shelter component to people's lives is very exciting. And it's you feel a lot of pride, you feel a lot of responsibility when we're going through this time and making sure that people are able to pay their rents and helping them and guiding them and helping them, get a hold of financial support if they need it, because not everybody's familiar with how the system works. So whatever we can do, it's a big, it's a nice, it's a good feeling to be able to do that.
Awesome.
Amazing, man.
Bobby, go ahead, buddy. You're up.
From Lisa Rabson today. What are everyone's thoughts as to whether the banks will extend mortgage deferrals? And if they do not, what do you think the market will look like?
Chris, you go ahead, my man.
That's a great question. And that is definitely, it's a great question because it's on the top of everybody's minds. And the quick answer is we don't have an answer at this moment in time. The sense we have, though, is that if you think about what has evolved, and it's evolved rapidly in the last 12 weeks, I think we can confidently, just from witnessing how proactive the government has been, banks have been, all parts of the economy have been to help people navigate through this time it is unprecedented. I mean, it's a word that's used often, but it is truly there's no playbook for this. There's no rule book for this scenario. So my gut says they're not going to, unless the economy has reopened to a point where they're confident that they're not going to have significant defaults, at that moment in time, there will likely be a strategy to allow people to defer further, just to let people get back on their feet. There is no value, and this is one thing I think we all have to remember. There's no value in causing major economic damage to folks that for reasons that were beyond their control. None of us purposely brought COVID around the world. I mean, nobody purposely has done this. And so we are in this situation. So I would, my feeling is that there will be, maybe it's not, a carbon copy of what's gone on so far. It'll be an evolution of helping people get through, because if they're unable to sustain, what would happen? Well, if they were unable to sustain, we all know at that point in time what would happen. It would be a challenging time for everybody, and not just the real estate market itself. These are people's lives. These are families. It would be a massive upset, not just economically in our world, and that's why I think you'll see some sort of solution beyond October.
And I think it's in the bank's best interest to do it, because
it is.
They're also thinking long term as well, and they know that they just need to weather this storm, and people will get back and start working. If they give another 3-month deferral, maybe till the end of this year, I think it's safe to say that 2021 will start to see that rebound come up again. And these are conversations that us three have all had with the major economists, with all the banks, and they're all kind of. They're saying the same thing, right? The start of the year, Q2, of next year is kind of what we're going to start to see the rebound.
Yes. Yeah.
Bobby?
From Mitch Parmasar. What's up, Mitch? Will the lack of inventory drive value up versus people's expectation and some experts talking about a drop of 6 to 8% in value for the rest of the year?
And Mitch, that's a great question. And that is exactly what we're keeping our eye on. So our sense is, and we're seeing in the way the market's behaving right now in the GTA, that where inventory is tight, prices are very solid. They're frankly, in some cases, they're still at the levels prior to March 15th. So, that's exactly what we see is happening, is as long as demand is there, inventory is tight, you're going to see prices go up. Now, where they're talking about values, coming off, and again, you have to remember, I don't want to, it's not a bad thing that values go up and down. It's a natural, the way markets behave. It's over the long term that we want to think about. But in the short term, the reason why they're contemplating values coming down as a potential is that there'll be less deal volume happening if we're unable to get the economy to open and get fired back up again. So people have to make predictions. It's like me, trying to, speculate what the banks are going to do in October based on some history and some valid facts. I'm speculating that the banks wouldn't just say, "Oh, well, sorry, everybody, good luck," and not extend. When you're predicting economically of what's going to happen, that's what they're doing. They're saying, look, there's ranges of, Ben Tal. We had Ben Tal on internally for our team a couple of weeks ago, and he's more of the mind that it's going to be, maybe 0 to -5 at the worst case, and that's a national picture. In the GTA, it may just kind of hover in and be flat for a year or so. So there's a whole range. All I'm suggesting there is there's a whole range of guidance. It is definitely based on supply and demand. The supply is limited, as we know. Construction has slowed way down, so new product coming into the market has slowed down. So a lot of things have kind of slowed down together, right? The question is how they start up again, and immigration will start faster than construction will. That's for sure.
So I do want to add a point, because you brought up Benjamin Tal, who is, again, a very inspiring economist because he goes so deep and he's so well connected. But I also want to bring up our CEO of Royal LePage, Phil Soper.
Yes.
Phil was one of the first people, if not the first person, to actually adjust and really give a chin check to our national media, who was calling for a catastrophe, really, off the bat. They kind of saw CMHC come up with that -20, and then it was -10, etc., kind of just scaring the living daylights out of the entire country. And he came out, and when we had him not on Brunch. Well, I can't remember if he was in one of our team meetings or if he was on one of our other broadcasts. But he toned down to us, and it was the exact same message he shared with national media, that prices, yes, the national market is going to take a hit, but that hit doesn't mean negative. He actually sees the national activity for the year to finish at 0 to +2.
Yeah.
So basically flat, in line with inflation in line with, like, he thinks we're going to recover, and like now he's being proven right every day as we're moving towards the right direction. So his estimates for that curve were based on science. So he goes, as long as our curve behaves like the curve should, based on evidence, we're going to be out of this by end of June. We're going to be recovering by September, and by end of the year, we should be back on our way to normalcy, which is precisely what's happening. So to have leaders like that to count on and be able to kind of make your own projections, this is why I wanted to interject and put this point in. So for all the investors who are building their businesses, there are people you should be looking and seeking out for their opinion, because their livelihoods, their entire existence relies on this data. Just like, Chris, your existence, your livelihood, there's nothing more important for you to have a pulse on than what's happening in the big picture. We're not talking about a transaction. We're talking about the big picture, and we need to know it, and we need to make smart decisions, just like this entire audience here today.
Yeah, absolutely.
From Candace Harris. Candace is putting us through our paces today. Okay, so there's 3 or 4 questions mixed into one here, guys. Is there a risk of
Candace? We love you.
Is there a risk of putting a property on the market and selling it below list price because of the number of days it may be on the market if buyers and showings are slowed? And how does the seller know when to list? Are there indicators in the market as a potential seller should wait to see? Outside of Toronto, she's got Milton slashed in there.
Absolutely,
Chris.
And it's. I mean, you guys can handle this too. I'll
No
give
way.
you my
That's a hard one.
The supply and demand numbers is something that we watch very closely. And so what you would do is assessing your micro market that you're in is what how many units are available versus how many buyers are happening in that moment, in that point in time. I know, like right now, depending in Milton, we do a ton of business in Milton. And it's a very busy market. I mean, Milton in the sub $1 million price point right now is super, super hot. And so you can look at those Milton stats, and the guys at REC will do this for you and dig in and say, okay, well, we've got just take round numbers. We have 100 houses available. We had 75 sales. We only have 5 weeks of inventory, or we have 50 sales, 100 homes, we got 2 months of inventory, whatever it might be. And from that, you'll be able to tell whether, how the market and the pace at which things are selling will dictate, what the effect on prices are right now. So the lower the inventory, there's tremendous, upward pressure on prices. The higher the inventory versus the number of sales, less pressure on prices. So that's how we would analyze that.
From Jennifer Kearney, Chris, assuming the chart numbers that you showed earlier are all properties, all areas on Treb, and is there permission to share this chart?
Yes, absolutely. We're happy. That is the GTA average sale price for each year, and the total number of sales of all properties, all categories, and by all means, I know. The guys will share that with you, and we're happy to share that with you.
Yeah, as Jazzy mentioned, send that quick request to info@REC Canada. I know Ty has put it up in the chat, guys. And if you have, like Candace, if you're actually considering listing something, you need the actual micro for the neighborhood to hit all those key economic points and market conditions. Just put in your email, give me the high level, the 40-year chart, but also give me my neighborhood data. Like we can hone down to almost the street. Well, not almost. We can hone down to the street.
Right to the street. Yeah, tell us the street that you're looking for. Simos Candace is an REC insider for a very long time. Next time, the only way you're going to get your question answered, though, Candace, is if you come online, because you need to come on live because we need to see that smile of yours. And so definitely, as Simos mentioned, write the street, write your address to Tyler, and we'll have someone make sure they give you the comparables.
From Catherine Rowley, should investors continue to buy real estate during COVID?
Well, that's a great question. It is. It's a question that each individual investor has to analyze their personal goals and their personal situation. and what their long-term view is. So real estate for us is a simple answer. It's always long-term. So, we're looking in the market right now because interest rates, you cannot, it's actually, in the GTA, I'm not sure where, in your market, what they are today, and it'll be relative to, again, what goes on in your market. You have to think about this.
Catherine is a GTA person, Chris, just so you know.
Great. Okay. So in the GTA, you've got 2% 5-year money being offered right now. 5-year fixed mortgages with 25-year AMs at 2%. I mean,
HSBC,
you paid a little bit more. Like, let's say you paid 2.5%. Oh my goodness, right? which is technically quite a jump, but it's not. I mean, but still 2.5%. I mean, unbelievable. So, but interest rates are so low. So if you've got the ability, if you've got cash and you're looking at long-term view and you're okay, because this is the other thing too, this is a business, right? I mean, we have to all remember this. We talk about investing in real estate. I mean, you go to work every day doing whatever you do, but you're investing in your own personal business when you're buying investment real estate. So, and in any business, whether you're the great Warren Buffett who invests over decades, there's ups and downs. So you have to be comfortable that in the next 6, 12, 18 months, it's going to be choppy. Like as I said earlier, just, what have the last 48 hours in the stock market done to your heart rate, right? It's a choppy time,
So I think it's more important.
But over time, it's going to be
fundamentals.
So if you look at the fundamentals, you look at if you can borrow money at sub 3%, whatever the range is, if you have a long-term horizon and you can make your cash flow work for you in your personal situation, I'm comfortable with it. That's my feeling. Now, is it for everybody? No, it's not for everybody. But if you're comfortable with it and you're taking a long view, could real estate get less expensive in the short term versus the long term? Yeah, absolutely. Is it possible? Sure. If it takes longer for us to recover, there'll be less pressure on prices in the short term. But I was reminded of this brilliant quote the other day. It's not about timing the market, it's about your time in the market. It's not about timing the market, it's about your time in the market. So I want to catch the bottom, or I want to sell at the peak. Good luck.
Good luck. I mean, someone like Warren Buffett hasn't figured that out.
No.
But him and Jeff Bezos were having lunch not long ago. I think before COVID time, but they were having lunch, and Jeff Bezos asked Warren Buffett, he says, Warren, like, why doesn't everyone just do what you did? And Warren looks over to him and he says, because nobody has patience. Nobody wants to wait. He goes, I'm actually not that smart. All I do, though, is I buy things and I just hold on. And on top of it, he goes, if I were to do all this over again, the investing in general, he goes, I would just buy homes and rent them out. So the man who's made the most money in the stocks and everything that he does said that if he were to do it all over again, he would do it in real estate, but having patience. I think you guys, anybody who's watching right now and has heard us or seen us more than once, that we talk about buying and holding because that's where real wealth is created. We've seen more people lose money on the flip side of trying to time it and up and down, and I'm going to start swinging hammers. All that stuff looks real good on HETV within a 22-minute time slot, but it generally doesn't play out as nice as it looks because the guys and girls that hold on to real estate over a long period of time, it goes up and down, upwards, and Chris was also just showing that slide earlier. If you did jump on late to this webinar, know that the recording does live on our YouTube page. It's youtube.com/REC experience. We have all of our past brunches in a playlist, and so you can always go back.
Jazzy, I want to make a big shout out. Because I know the point you're trying to drive home is to stick to fundamentals of long-term real estate investing, but I do want to give kudos and props to your guest, on Thursday night on Nightcap, Sahil Jaggi.
Yes.
If you want to learn how to, you want to swing a hammer, you want to get fancy, do you want to have a little bit more of an exciting portfolio? No problem. There are ways to do it and there are ways to do it. And the way to do it right is, again, Sahil does not swing hammers over 3 months and try to time the up and down of the market. He has a 5 to 7 year plan. So if you want to renovate, you want to add value, you want to swing hammers, you want to go down that path of real estate, I'm not telling you that it's not lucrative, because he will tell you that he makes $1 million a pop. But he does it over 5 to 7 years. He does it carefully. At no point is the property bleeding. So it's always cash flow positive. From the first thing he will do, he'll buy the bungalow, he's going to add the basement. So he'll put 50, 100K out of his pocket immediately to make sure that there's a double tenancy, a 2-door or 3-door investment. The minute that those doors are rented, there's cash flow. Now it becomes back to Chris Slightham's wheelhouse, where there is a steady cash flow over time, over the next 5 to 7 years. Going back to what Jazz was saying, if the average is 7%, what has happened in the last 5 to 7 years? The property has a gain in equity, so now you have a delta of value creation, so forced appreciation. You have the appreciation that naturally went up over time, and you have, of course, the mortgage pay down over 5 to 7 years. Guess what, Mr. Investor? You're winning today. But it took 5 to 7 years. It took work. It took due diligence to pick the right neighborhood. So don't allow anyone to tell you that it's easy. Never get excited and emotional. Stick to the fundamentals. So the best thing you can do is never touch it again. Precisely like Chris was saying, you buy it, you maintain it, you have strong relationships with your tenants, and you become a housing provider. But if you do want to see those intermediate gains, if you're more aggressive or you don't have the time, the luxury of time that others might, and you do need to make moves, there are ways to do that. And never forget to build your power team that can counsel you and take you through those types of maneuvers, because that's exactly what they are.
Gentlemen, from Ed, how is the rental market downtown Toronto? I've heard of rents declining by 10%. How's the tenant pool size / vacancy rate? And I've heard lots of short-term rentals are now looking for long-term, hence impacting the supply and demand.
No, it's Ed. You're very well informed on the market. Yes, it is. It's a temporary moment in time. So you you hit all the factors right there. They stopped short-term rentals. The city of Toronto said under COVID, it's too dangerous to have people coming in and out of spaces in a short-term fashion. So that stopped. We stopped travel. So business travel, is at a halt. And immigration has stopped as well, temporarily. So for a temporary moment in time, there is less demand on downtown rentals. So prices have come off about I think 10% is a fair number. We don't have the exact data yet, but we're roughly in that range. So yes, to all those factors. Now, again, if you're an investor who owns a condo downtown and you were getting, $2,200 a month and now you're getting $1,950 or something like that, do you, oh my goodness, the sky is falling, I got to get out of this thing. We come back to, hold on, pump the brakes here. Let's remember what the goal is here. Let's remember what the value creation over a long period of time means. Now, as long as you can sustain from a cash flow basis, which frankly, and Simeon just hit the nail on the head there. You've got to be prepared for some changes in the market over time, because this is not a sprint, right? It's a marathon here. We're going long term with this, and so in this moment in time, yes, is it choppy in the downtown market? Absolutely, but for what I would call artificial factors. We're not in a financial crisis here. We're in a health crisis. We have had to globally stop travel 100%. Talking about people who are in business who have challenges right now, could you imagine if you're running an airline? That's unbelievable. Like restaurant businesses, that's unbelievable what's going on. But people still need a roof over their head. And so from a long-term basis, there will be stability. But that's that choppiness I mentioned earlier that I want you to think about as an investor, and just acknowledge it. It's okay. It's going to be choppy. That's what I signed up for. I signed up for an investment that over the long term is going to be great, but there's going to be moments in time it's going to be choppy, and we're in the rough waters right now. But the calm waters are ahead, and we'll be coming out of them. Just patience needs to take us there.
And Ed, if you're looking at the negative $250 in the example that Chris just gave, from 2,200 to the 1950, if you have to carry that for the next 6 months, okay, if you need to carry that for the next 6 months, we're looking at $1,500, okay? But that $1,500 is not going to waste. That's going to pay down your mortgage. Over the 3 years after that, you'll be able to refinance it. When you're refinancing it and pulling out $50, $80, $100,000, I guarantee you, I promise you, after having done this with thousands of people, you're going to forget about this $1,500 that you just paid. It happens all the time. I've done it personally myself, handful of times, where I've had to actually take it from my left pocket and put it into the right pocket, no pun intended, and make sure that if I'm able to, as long as I'm able to cover it, because we all know how quickly we spend $200. If this panel of 4 people was at Joey's here at Shops in Don Mills, $250 would be gone in less than 15 minutes. And
it's
so
true.
we forget where we spend $250. Your Netflix, your Hulu, your Disney, and your internet is $250. But when we speak about it from a long-term perspective with your investments, it's a little harder to fathom. So Chris, you said it perfectly. You said, let's acknowledge it. As you said it, you said it with such ease and comfort, and it's exactly that. Just acknowledge it. Know that it's part of the game. It's part of owning a business. There's always internal theft that happens at Shoppers Drug Mart. They don't shut down their business because someone stole some medication. They understand it. They acknowledge it. They try to figure it out.
And it's part of the formula.
It's part of the pro forma. Part of the business. And so I love how you said that, Chris. Thank you for articulating it that way.
It's like you said, Jazz, even if it's $200 a month for 3 years.
Yep. Right. Yep. Do the math on that, right? We're talking about $8,000, less than $8,000.
$7,200, I think, right? I mean,
and my tax accountant will like that $8,000 loss of mine as well, right?
There's lots of ways, and over a lifetime of owning an investment, the $7,200, to your point, will be long forgotten when you see the long-term value. But that it has to work for everybody, and I think we have to acknowledge that, and just whatever works for your situation.
Bobby, why don't we get a couple of more questions in, and then we're going to have to let Chris go because he's been really, really gracious with his time today. Make sure you tell your beautiful wife and your kids that we are very, very thankful for your time, Chris. Go ahead, Bobby.
From Ken Lacroix, it has been said that the increase in teleworking due to COVID will remain higher than it was pre-COVID. Some are speculating that this will allow new and existing homeowners to move to cottages and or less expensive but very attractive cities and towns. What are your thoughts on that, guys?
Yeah, I mean, my 2 cents on that is I think that there's definitely going to be what I've enjoyed about the time that we've had is we've got to know our homes better, and so I think people we've learned how they function, we've learned what we like about them, we've learned that maybe there is different things that now that I've spent so much time at home that I'd like to change. So I think there's actually going to be quite a bit of discussion around lifestyle and people choosing to telecommute. On the telecommute side, though, I'm still on the fence on how functional that is going to be on a long-term basis. Of course, does it sound fantastic to be able to work at home part of the time? Yes, there is some value to that, but I also know from a productivity standpoint, for all of us, it's a little tricky on a long-term basis. When things get back to normal, whatever that's going to look like, I think the jury's still out on how much telecommuting is going to be. There are early signs of people that are choosing, throughout our organization. I get to see a lot of transactions that are happening, and there are conversations around folks are saying, you know what, I'd like to maybe move out of the downtown core and buy a property further away, because it looks like my company is going to allow me to telecommute at least a day or two a week. So there is going to be some of it, but would it be a wholesale change in the market? I'm not so sure it's going to be a massive, 50% of the market's going to go that way. There'll be a portion, but I don't know if it'll be a wholesale change.
I'm always reminded of 9/11 with that, where like going into 2002, everyone was saying, okay, no one's going to want to work in skyscrapers, and developers are not going to build, tall buildings, and no one's going to want to fly anymore. And we all know both those things never came true. And so I'm interested to watch that, like, to see the progression or the lack thereof of more people working from home. I mean, I think anyone on the REC team knows, especially the core people that are here on a regular basis, don't get used to this, because once we're reopened, you're coming back to the office, and that's just the culture that we build around here. It's we're working together. I love the virtual offices, and we adapt and all that, and that's great. And personally, we've been able to see how much we can push ourselves individually, but you're all coming back very soon, guys.
No, but let me add this. It's not just the team coming back. It's not just the team coming back, Jazz. Once this is over, you know the couple hundred people watching right now? They're going to be back at the office having a little wine, having a little cheese.
For sure.
I threaten you all with a good time.
And that's good that you mentioned that, guys who are watching and have had wine and cheeses here, and all the catering we do at the office here at the shops at Don Mills. We haven't really done much in our Mississauga office, but it's the exact same, right down to the doors, the carpet, and the glass. It's because of the gentleman that you see. His younger brother, Jeffrey Slightham, is not here. But if you are watching the recording or you are on this webinar, we love you just as much, Jeffrey. And so to the Slightham family, you guys allow us to do the studio and do the podcast in the back, and you allow us to bring all of our clients and our friends and use the lunchroom, and we do big parties in there, and we educate. So thank you for that, Chris.
I love the fact that you use it and you bring so many people together and educate. I mean, that's really what it's all about. I think it's a fantastic use of the space, and we're proud of it, and we love welcoming so many people in, and it's great to see, and we're looking forward to that day when we're able to get full use of the space.
Can't wait.
Bobby, why don't we throw one more question at Chris, and then we'll ask him to leave our REC insiders with one tip, one strategy, how we always close it off. So Bobby, you get to pick that last question for Chris.
I think it's an interesting one for the future of the GTA, just in general, Chris, sir. Will the shortage of development of land ever catch up with the need we have for housing? In your view, is this ever even a possibility?
It's a great question.
That is a great question, and that's something we always are thinking about, and because that's right on point with supply, and there is, it will become very relevant over the next 2 decades in particular, based on the trajectory of immigration. And so there is a possibility that, we will run out of, land someday. It's not something that I would see in my lifetime or even in my children's lifetime. But what it'll do is it just creates densification, right? So what we do is, we don't have any room to grow on ground level anymore, but we do have, probably, I don't know it'd be interesting. We should probably have somebody do this math for us, but I don't know how many years ahead of densification do we have? So
right.
We'll call, vertical communities, right? The condominium towers that we're building, we have, decades of room to grow there. Now it's going to change lifestyle. It's going to change the dynamics of neighborhoods. But in our lifetime or our children's or our great grandchildren's lifetime, it would hard to imagine that we'll truly run out of space. Like, let's say, Manhattan being an island, it has what it has. Now they're still building on the island of Manhattan, but all they're building is high rise. There's no new low rise. I mean, they may tear something down and replace it because of the zoning requirement, but everything that's coming down, generally speaking, on Manhattan is going up. So they're adding the density. So there's a good example that they're decades ahead of us in terms of.
And Chris, our good friend Peter Papailias from Graybrook,
yes.
We had him I don't know 3-4 months ago. We had a conversation about just that. And not only are they decades ahead of us in density, but Toronto's all like as well. It's 4 or 5 times the size. You could fit Manhattan inside Toronto proper 5 times.
Yes.
So we have more room. It is going to be a slower. So that's why there's so much new mid-rise, and they're not forcing high-rise because there is still. It's more livable. Toronto will always be more livable than New York. Yeah. Always. We have a much more bigger and consistent lakeshore. We just have a different design. It's a newer city. New York's older.
Yep.
So we're not going to have those issues, but we have decades of density and air rights left to exploit and use to make our city better, faster, and greater. So I love where you went with it.
Yeah. And there it is. I mean, there's lots of growth there. And really the issue right now that we have is the speed at which we can deliver the housing relative to the growth of the population. And that's what you need to keep your eye on as an investor going forward.
Simos, I didn't tell you, but you'll be buying Chris lunch next time we see him, because we had a little bet to see if our insiders could stump him. Obviously, we never got to that. Our boy brought the goods. Thank you so much, Chris.
My pleasure.
I can't say it enough. I know I speak for everyone who watched, the wealth of knowledge that you bring to the community at large, not just to what you did today on the webinar. It is very, very greatly appreciated, and thank you. And so with that said, leave our insiders with a tip, a strategy. It can come from an investing perspective. It can come from a mindset perspective. You manage and run an organization of close to 1,300. I mean, you have your 1,200 realtors, but I'm probably off, and I don't mean to insult you, but it's probably more with your staff. You're probably at Jazzy's lucky number of 1,300 of 13. And so you bring a wealth of knowledge from that perspective as well. Can you leave our insiders with something, my man?
Yeah, it's great. And first of all, thank you guys very much. We all kind of align because we are so, we appreciate the value of real estate and what it can do for people. But I think the idea of education is critical. So, there's a couple of things. One, patience is critical. And I think, in real estate, one thing that my dad and my grandfather taught us is that you have to take the long view of things and always be sure to when you're making your real estate decisions, be prepared for the long term. The challenge with real estate is you really only lose money in real estate is if you have to sell it. And that is something that, you have to, as investors, you really do have to be cautious and thoughtful around your plans, so that, God forbid, there's a bump in the road, that you're not forced to sell an asset. Because over time, time heals all with real estate. It's going to continue to rise over time. We're in a great marketplace, but that's something that has always stuck with me. Slow and steady, long-term view, patience is huge. And the other thing is Ray Dalio, he's got a great book called Principles, and I highly recommend you get it if you haven't had a chance to read it. But one of the quotes that he said is, the quality of your decisions will determine the quality of your life. And that really has stuck with me. So the quality of your decision making will determine the quality of your life. And so what that to me really means is the more you can educate yourself and have great advice and great resources and study, the better your outcome is going to be. And so to invest a morning, an hour and a half, whatever it is, in yourself, to learn and think and plan on a long-term basis will help you make better decisions, which will, the results you'll have long-term will be exciting, incredibly exciting. So hopefully those two thoughts are valuable.
Amazing.
It's been a real pleasure. I really enjoyed it. I'm glad we were able to appreciate the invite and the opportunity to come on. I know you guys are doing incredible things. You're educating so many people, and it's it's great to see. And congratulations to everybody for participating in this morning, because I'm sure we all have lots of things we could be doing, but this is a big deal, and there's such an opportunity for everybody here, and I've been really appreciative to be a part of it. So thanks a lot, guys.
Thank you again, Chris. Talking about quality decisions, REC came over and merged with Royal LePage Signature and come under the umbrella under Royal LePage Signature a little over 10 years ago. And we're happy we made that decision, because it did change the course of our lives. And REC it's a huge benefit to be even within your organization. And we can't say that enough. So thank you again for your time, Chris.
Thank you, and it's been an absolute pleasure, and look forward to chatting again.
Awesome.
Have a great
Thanks
day,
a lot.
everybody. Thanks, guys.
Chris, be well. Have a wonderful weekend, pal. Enjoy the family up north, and we'll see you early next week, man. Your insight is invaluable. Everybody, I've seen hundreds of comments roll through the screen. Thank you, and I'll see you on Monday, man.
Okay,
And
look forward
at the
to
start
it.
of the pandemic, I told you when I see you, I might kiss you. So just be ready for it,
Watch
because
it.
I miss you that much.
Stay safe.
Later,
Okay,
buddy.
stay safe.
Stay safe.
Take care, guys. Great to see everybody.
This has been the REC Experience Podcast with Jazz Takhar, an REC Canada production.
Hey guys, thanks so much for watching and listening. Please take a second right now to subscribe and follow us on whatever podcast platform you're watching or listening. It means the world to me. Thank you.